Well, over the course of the next hour or so, I'm going to provide you with an introduction to financial markets. There's an important role that the financial markets actually play, and we'll discuss obviously what that is. We'll get into the different regulations regarding financial markets. I'll give you kind of an overview in terms of the legislation that we've seen happen over the course of the last roughly 100 years or so, and how that's shaped the financial markets that we see today. We'll also discuss investing in financial securities. We'll go over the different types of securities, common stock, preferred stock, and bonds. We'll discuss mutual funds, ETFs, and then we'll discuss primary as well as secondary offerings, primary offerings being initial public offerings, commonly referred to as IPOs. And then we'll talk about market indexes and stock indexes, things that allow us to get a gauge on the performance of the market, looking at things from a macro level, as you know. So the first thing we want to discuss is, what is the role of financial markets? What is their primary purpose? Financial markets serve a few different purposes. The first of which is they serve as a marketplace to transfer funds from savers to borrowers. They allow to partner individuals who maybe have financial resources and want to get a return. We talk about finance, right? Trying to get a return on those financial resources. And so they invest those or have those held with banks. They invest those in companies as a way of getting some type of return. And then you have the other portion, the other person in the transaction, who in turn can take loans from banks, having access to capital, or the company obviously having access to funds from investors so it can further its operations and put money into things like research and development, or expanding production, or purchasing equipment, and those different types of things. So financial markets are very important because they pair the saver, the person with money, with the borrower, the person that needs money for whatever reason. And we all know that companies need to have access to financial resources, not only for purchasing equipment, but also for investing, meeting payroll guidelines, and all of those different things. And so we, even as consumers, are very big players in financial markets. You know, government goes to great lengths to try to establish an environment that's very conducive to investing. There are legislation that's been enacted in order to provide investors with confidence so that we feel confident in providing our money to banks, to companies, to the government, and to various other key players. And if we don't feel confident in doing so, that's ultimately going to affect the entire financial system. And if you remember several weeks back when we started talking about ultimately how money is created, banks play a very pivotal role in ultimately the creation of money. Not necessarily the physical creation of money, right? That's usually done by the U.S. Mint and the Treasury. But they actually create money through taking deposits and making loans. And so if investors or consumers aren't depositing money in banks for whatever reason, that is going to have a significant effect on the financial system. It will all come to a screeching halt because it all depends upon people, savers, putting money into companies and putting money into banks. So who are some of the people that need access to financial information or financial resources? Stockton, California, of course, would be obviously very into receiving some type of financial resources. From those that know, obviously Stockton is going through a bankruptcy filing, essentially stating that it cannot meet the demands of its creditors. Most notably, it has very high pension costs and those different things. Stockton would obviously benefit from an influx of financial resources. Research in Motion, the maker of the once popular BlackBerry smartphone, obviously would benefit from financial resources as well, specifically in the position that it's in now with very, very dwindling market share, obviously not having a great deal of financial resources available. It does have a pretty decent amount of cash, which does allow it to obviously weather these difficult times, but certainly in RIM's case, they could certainly use some additional resources. And lastly, you have consumers like you or I. Now, obviously, if we have a need to purchase something, in this case, let's say a vehicle, we obviously want to have access to the funds in order to make that particular purchase. And so financial markets would allow us the opportunity to gain access to those resources. Maybe we don't have the financial resources necessary to pay cash for a car, but assuming we have pretty decent credit score, relatively good standing, pretty decent income or debt to income ratio, not too high a debt load in comparison to our income, we could be eligible to take out a loan in the financial market and then use that to purchase a brand new vehicle. Now, financial institutions play a very important role, and I already mentioned the fact that they obviously help create money, not actually create it themselves, but they provide an environment in which they can take loans and then, or take deposits and then obviously make loans as a way of expanding the money supply and providing everyone access to those resources. So what are the different types of institutions here? I'm not going to go through these one by one, but I do want to highlight a few of them. You have commercial banks. Obviously, we're familiar with commercial banks like Bank of America, JP Morgan Chase, perform a variety of different services. A lot of times they do mortgages, they do vehicle loans, they provide checking accounts, they have savings accounts. Commercial banks perform a lot of different functions. They're almost like kind of the one-stop shop with regards to banking. So typically they are very, very large, at least the most notable ones are like the ones I mentioned before, and they provide a great variety of services as well. We're going to get into some of the changes with regards to regulation in a few moments from now, and we're going to discuss how that ultimately has affected commercial banks. Now, you also have different institutions as well. You have credit unions. Credit unions obviously being typically much smaller. They typically work on a regional or local basis. And credit unions are usually serving a certain group that has an affiliation. For example, you have Educational Employees Credit Union, commonly referred to as EECU, which is a very popular credit union here in the Central Valley. And they are obviously known for primarily working with teachers and people that are in the educational field. And that's how originally they started. Now they've expanded their consumers, or who they serve, to include really anyone for the most part now. But originally they started to serve consumer or education users like teachers and different people specifically. But since then they have broadened the consumer base that they serve to really include everyone for the most part. But they offer very similar services to a commercial type bank, but typically you can usually get better rates with a credit union. They may be a little more conservative, so they may scrutinize certain documents a little heavily or more heavily than a commercial bank might be. But typically you can get better rates from a credit union, and usually you get that more personal service as well, although it does obviously vary. So next we're going to go over some of the depository financial institutions, or non-depository I should say. The initial three being commercial banks, obviously credit unions and savings and loans associations do take deposits and then obviously lend that money out, which is how they earn revenue. But we also have non-depository financial institutions, meaning that financial institutions that do not take deposits in any way, shape, or form. In large part, you have institutional investors. Institutional investors typically take the place of pensions, insurance companies, very, very large companies that have multiple billions of dollars in assets that they're investing in financial markets. And so if you were to look, if you take a particular company, let's say Google or Apple, and you look to see who are the largest holders of stock for those companies, you're going to see in large part that a number of institutional investors like pension funds, mutual funds, and insurance companies are in large part the major holders of those stocks, because what they do is they pull money together from their various constituents. So say pension funds, for example. If you have a pension, you typically are committing certain financial resources towards that pension, and then the manager of that pension fund decides where to invest them. And so you're not investing merely 1,000 here, 1,000 there. I mean, you're talking about multiple millions, if not billions of dollars that are being invested in various stocks of various companies. And so they have a lot of clout, obviously, because they simply use a large amount of resources, and they have a large amount of resources at their disposal. Now, you also have securities brokers and dealers, which are typically the individuals that will connect you to the financial markets as a way of actually purchasing stock in particular companies. And then investment banks, of course, as well. We're finding that a lot of commercial banks now, due to changes in regulations, do have an investment banking kind of function as well, but for a large amount of time those were considered to be almost separate, although we've seen that change recently. But a very popular investment bank, or one of them at least, would be Goldman Sachs, and they typically help companies go through the initial public offering process, get the initial public price set for that particular stock, and perform a variety of other functions as well. So we've seen a lot of changes in regulation with regards to financial markets. Obviously, savers and borrowers are very concerned about their investment being protected. And that should be a paramount concern with investors, is how confident are you not only in maybe the performance of a particular company if you're going to purchase stock in a company, but how confident are you in the entire system? And so regulation is designed to try and instill public confidence as a way of protecting investors so that ultimately they know that they're going to be taken care of and that there are sound practices in place to protect them from deceitful practices and other things that could run the risk of ultimately losing their investment. So as an example of kind of how the malfunctioning of the financial markets take place, we've all seen this with the latest economic recession that began in 2008, according to a lot of economists, ended at some point in 2009, and we're currently in the very, very slow recovery process back to the point to which we were before. But this, many argue, it was a malfunctioning of the financial markets because there wasn't a great deal of regulation surrounding things like collateralized debt obligations, referred to as CDOs, or surrounding certain things like credit default swaps. Credit default swaps, for those of you that maybe don't know, is essentially like insurance that you could take out to protect your investment. So if your investment essentially was no longer there, you had insurance to cover that. The problem, though, is this wasn't very regulated, and you had people taking out insurance on stocks and on different things that they didn't even own. And so it was almost like an organized kind of gambling ring, and they were betting on different stocks and betting on their particular failure. The problem with that, though, is that these companies weren't keeping reserves. And so most banks have to keep reserves on file so you can pay people when they have a claim. Insurance companies, for example, like State Farm, Progressive, Farmers, and others, have to keep reserves so that in the event that there's an accident, they have money set aside to pay those claims. Well, in this particular example, credit default swaps weren't regulated to the point to where they had to keep reserves. And so what you ended up happening is the financial system began to crumble. Obviously, the housing market began to crumble. People had these credit default swaps insuring their investment, but the actual institution wasn't actually keeping reserves, so they had nothing to actually pay, which was in large part one of the issues among a variety of other issues. But outside of that, you also have some significant bank failures in 1907, obviously 1930s being the Great Depression, and the 1980s that really shaped the financial market landscape. And so you see a lot of legislation come out of those particular events as a way of trying to protect consumers from some of the things that are taking place. You know, hindsight is always 20/20 looking back. And so that's kind of one of the issues that comes up, is at the point in time, nothing was really done. Once it gets really bad, then you have the ability to look back, assess the situation, and then of course change it so that hopefully it doesn't happen again. So let's look at some of the different financial regulations that we've seen take place over the last several years. I'm going to give you a little bit of an overview so that you have just some understanding of what is taking place here. I'm not going to be overly specific, but I at least want you to understand the general theme. A lot of these have a number of different things that they accomplish, and so by no means am I going to encompass the entire piece of legislation, but I do want you to understand some of the major themes here. So the first thing that we have So let's discuss some of the major legislation that has come out over the last 100 years or so. Now, the first one took place in 1913, and we've discussed this already at great length before in this class, and that is the Federal Reserve Act. As we know, the Federal Reserve Act created the Federal Reserve, which is the central bank for the United States, in charge, obviously, of monetary policy and also ensuring that we have stable employment and ensuring that we have at least stable pricing, there's not significant inflation and those different types of things. We've discussed already in great detail the Federal Reserve, not only its functions, but also the tools that it uses, the general composition of it, and all the other important factors here. And that was significant in terms of the creation of the Federal Reserve at this particular point in time. The next major piece of legislation that came out over the last several years was what's known as GlassSteagall, also referred to as the Banking Act of 1933, and this did a number of different things. What it was created was in response to the Great Depression that took place, obviously just prior to that. And it did a lot of different things. Some of the more significant things that it did, though, was first, it prevented commercial banks from being involved in investing activities. It viewed if commercial banks would be involved in investing activities that found that they might indulge in riskier investments, which could, of course, affect the confidence that depositors had, and so they didn't necessarily want that. And so now commercial banks were prevented from being involved in investing activities. It also provided more strict oversight on commercial banks by the Federal Reserve. So the Federal Reserve was giving more power essentially to kind of oversee and police member banks to make sure that they're acting in a responsible manner. All right, next we have a number of different pieces of legislation that happened in a really, really short period of time here. One of the most significant things that we saw was in 1999, we have what was called the Bliley Leach Act, also referred to as Financial Services Modernization Act of 1999. And the most significant thing this did was it almost completely did away with the restrictions that were imposed by Dodd-Frank. At this point in time, we thought that we had kind of learned from our ways and that different technologies, we wanted to take advantage of them in different financial securities and different financial instruments. And we really thought that bankers and the banking industry in general had kind of learned from the past mistakes and had the ability to kind of police themselves. And so we reduced the restrictions that Dodd-Frank imposed. We allowed commercial banks and other financial institutions to be involved in investing activities, of course, which means they can do things like collateralized debt obligations and credit default swaps. And this was a source of a lot of criticism, especially now in kind of rolling back some of the regulations and restrictions that were imposed by Dodd-Frank. The next significant piece of legislation, of course, is Sarbanes-Oxley, which was put into effect in 2002. And Sarbanes-Oxley was put into effect in response to a lot of the accounting scandals that have taken place, most notably Enron, WorldCom, Tyco. And so it imposed stricter penalties on certain unscrupulous dealings with regards to companies. For example, the CEO and CFO had to personally sign off on any financial statements, and if those were not accurate and it was proved that they were not accurate, they could suffer personally, be liable for those particular statements and not being able to hide behind necessarily the corporate veil that we call it. They'd be personally liable and can suffer criminal charges. But also on top of that, it required banks, or not necessarily banks, but companies to utilize independent auditors to look at their books. So the problem with obviously Enron was that you had Arthur Andersen, who not only was in control of monitoring the books and different things, but it also was responsible for doing the auditor's report. And so that creates a very significant conflict of interest because if you have a rather large account, you might do things to maintain that account because that's a significant source of revenue for you. So now the company that was handling the books, so maybe Deloitte, maybe KPMG, one of the other big four accounting firms, if you had one company that handled all of your bookkeeping aspect or the accounting function of your firm, you couldn't use them to actually do your auditor's review for your annual reports. You had to use an independent firm, someone who was not already involved in the day-to-day of your company so that they were more impartial and you would get a very impartial result. And the last piece of legislation that just went into effect in response to our latest economic recession is the DoddFrank Act of 2010, which was signed into effect by President Obama not too long ago. And this did a number of different things. Most notably, though, is it's kind of increased the regulations surrounding some of these more intricate and complex financial instruments. One of the problems is that we really weren't up to speed on all of the different instruments that created a lot of the laws and legislation that was created years and years ago, didn't have the slightest inkling of things like collateralized debt obligations or credit default swaps. And so what this did is it provided some type of regulation over those things so that we did do things like keep reserves and other important functions, as we all know. Dodd-Frank also established a separate arm for the Consumer Protection Agency in order to protect consumers from unlawful and unscrupulous lending practices and different things of that nature. So very, very important piece of legislation. Obviously, like all pieces of legislation, there are criticisms and there are people and proponents of it, but that's kind of the general overview and gist of what the act accomplished or what it was designed to accomplish. So let's get into some of the different investing aspects with regards to financial securities. There are three major types of securities that are commonly traded in financial markets, and we're going to go through these real brief here. The first one is common stock. We also have preferred stock, and then we also have bonds. And once we finish with these three, we're going to go into mutual funds as well as ETFs, and I'm going to give you some snapshots or what are things to look for with regards to those different types of securities. So the first one is common stock. Common stock is what we commonly refer to when we say I purchase stock in a company. Generally, we're referring to common stock. And contrary to this particular image here that you see, common stock, if you were to purchase stock in a company, you no longer actually get an actual certificate demonstrating that you have a certain degree of ownership. Now everything is kept track electronically because usually sometimes people will trade in and out of a particular stock over the course of an hour, and so it really wouldn't make sense to have a particular certificate printed, issued, all to have it obviously destroyed and then another one printed and issued. It'd be just counterproductive. So we keep track of things electronically. If you utilize any type of a broker or a discount broker like an E-Trade or Scottrade, all of your ownership is kept track electronically, so we don't have to actually keep track of physical certificates and different things. So what does ownership of stock allow you to do? What's the whole point? If I'm going to put forth an investment in a company, what am I getting in return? Well, you get a couple different things. The first one is you get voting rights. For every stock that you own, that entitles you to one vote for that company. Remember that as a stockholder, you are considered to be an owner of that company. But because you can't be involved in the day-to-day, we elect the board of directors to oversee operations and to kind of reflect our interest and voice our concerns. And then the board of directors, of course, will appoint corporate officers and different things to handle the day-to-day operations. The board will, of course, oversee the performance of individuals like the CEO, but they're not involved in the day-to-day. They typically will meet on a monthly basis and discuss kind of the overall strategy of the company and different things, but they aren't involved in the day-to-day decision-making, of course. So if you hold stock in a company, you're entitled to voting rights when there becomes a board member or a position vacant that has to be voted on. So the more stock that you own, the more voting rights that you have. So if you control a very large percentage of a company, obviously that gives you significant voting rights and you can sway ultimately the decision. If you have a handful of shares, it gets really difficult, of course, to affect the outcome of a particular decision. The next thing that we get as a result of having ownership or stock in a company is we have a right to dividends. Remember, dividends are quarterly payments that companies can make as a way of rewarding investors for holding stock in their company. Not all companies pay dividends, but a good number of them do. Typically, the more common, more financially stable companies usually do pay some type of dividend as a way of providing at least some return to investors. So if a company does pay dividends, then owning a particular stock will entitle you to that. For example, McDonald's pays a 77-cent per share dividend. So for every stock you own, you get 77 cents. So if you only own a few, maybe that's not a significant return, but if you own a number of them, then the dollar amount that you would receive every quarter could be pretty significant, and that's really how it works. The next thing that you're entitled to are capital gains. Capital gains is what we call share price appreciation. So if you buy a stock for $10 per share, it goes up to $15 per share. We would say that your capital gain is, of course, $5 per share, or essentially your investment has increased by 50%, which is very, very significant. So that would be a very, very good return, of course, on your investment. And so as a holder of that stock, you have the right to capital gains. Now, that doesn't mean you have a guarantee of capital gains, because it could be that that company's share price actually goes down in value, in which case you would suffer a loss. But you don't lose your money officially until you actually sell the stock itself. It's all considered to be paper losses at this point. It's not official until you sell your stock. So if you purchased a company stock for $10 per share, it goes up to 15, and all of a sudden goes down to 9. You don't necessarily get to capitalize on those gains because you didn't sell your stock when it was at $15 per share. All right, another thing that it does, and this is very significant here, is it provides a residual claim on assets. And a residual claim on assets is very, very important. Stock is considered to be a relatively risky investment. And the reason it is because in terms of when we are paid, liabilities, of course, remember from when we talk about accounting, liabilities or loans and different things, those types of creditors are paid first. Whatever is left over is divided up between existing shareholders. So usually if a company is in a position to where it has to liquidate due to bankruptcy, then the chances are that stockholders are not going to get a whole lot. Now, with that said, they do have a claim on assets, but they are very, very low on the list in terms of who actually receives that particular money. So after bondholders are paid, after creditors are paid, after preferred stockholders, which we're going to go over in a few minutes, are paid, then those that hold common stock would essentially be paid at that particular point. So we're very low on the list, but there still is a claim on assets. One of the things I realized I just skipped over is preemptive rights. And what preemptive rights entitles you to do is, in the event that a company were to issue new stock, a lot of times those that hold existing stock have the first right to purchase those new shares. And the reason that's done more often than not is because if a company issues new shares, what that does is it dilutes your ownership. So instead of owning 5%, maybe there are now more shares out in the market, so other investors purchase those. Maybe now your percentage of ownership is 4 or 4.5%. Which may not be a big deal, but it can be when it comes down to voting for certain things. And so typically there are preemptive rights instilled in most common stocks. So when a company decides to issue additional shares, its existing stockholders have the first right of refusal almost. They have the ability to purchase those shares. If they decline, then ultimately it goes into a secondary market where new investors can gain access to those. So next we're going to talk about preferred stock. Preferred stock is very similar to common stock, but it has certain preferential treatment that exists for the holders of that particular type of stock. The first thing is it does, very similar to common stock, provide a return on asset or a claim on assets. In order of who gets paid first, though, someone who has preferred stock would be paid first before those who hold common stock. Preferred stock typically is more expensive, which is why it's preferred, because you get additional benefits. So that's one thing I failed to mention before. The next thing is preferred stock oftentimes ensures a payment of dividends. Common stock, it's not always guaranteed. Some companies don't necessarily issue dividends for common stock. They decide to roll over that net income or profit and reinvest it back into the company into retained earnings. But with preferred stock, there generally is always dividends that are paid, so they would be entitled to those first. With common stock, there's no guarantee that the company will pay an actual dividend. All right, another particular type of security that's used very common as a way of getting access to financial resources are what are called bonds. A bond is simply an IOU. It's a long-term debt that could be issued by either a corporation or it can be issued by the government. Right? You have U.S. Treasury bonds, which is the U.S. government essentially saying, hey, you know what, if you give us X amount of dollars, maybe $1,000, we'll pay you back in 30 years with this additional payment as a way of making it worth your while, so to speak. So interest is paid on bonds, of course, as a way of compensating investors for not having access to our money for a particular period of time. So how do bonds work? There's a couple different components that you need to be aware of. The first of which is the maturity date. This is when the bond is going to become due. So if we have a maturity date for December 31st of 2020, for example, that would mean that on that particular date is when the particular issuer, either a company or a government entity, needs to pay you that what you had invested, in addition to, obviously, some type of interest rate, which is commonly referred to as a coupon rate. The next you have is the par value. Par value is the face value of a bond. Okay, par value can be very, very different because if the face value of a bond is, let's say, $1,000, that doesn't mean that the bond sells for $1,000. The bond could sell for what we call a premium or a discount. If it sells for a premium, that means the market value of that bond is greater than its par value. So let's say, just for sake of example, that the market value is $1,100, but the par value is $1,000. Well, by definition, you would be purchasing that bond at a premium. You're paying greater than its par value, and that typically means that there's greater demand for that particular security. You can also purchase bonds at a discount, which means you're buying them for less than their par value. So if the par value is $1,000 for this particular bond and you purchase it for $900, you are essentially purchasing at a discount, because what that means is that at the maturity date, you're not going to get $900 back. You're actually going to get $1,000 back. So you get back the face value or par value on the bond in addition to the interest rate on that particular bond as well. The next two components related to bonds you need to be familiar with. First is the coupon rate. The coupon rate is the interest payment that is paid on the actual bond, typically denoted as a percentage of the par value. Okay, so if we're paying a 5% coupon rate, that means it's 5% of $1,000, and so that would be the interest rate that you would actually receive on that. Now the coupon rate differs from what's called the current yield. Remember, the coupon rate is the percentage of the par value, which is generally, let's say, $1,000. But the current yield is that interest payment reflected on the actual market price. So if we're paid 5% as a coupon rate, our current yield would look very different than 5% if our market price is $900. Instead of actually being just a 5% coupon rate, we would take our 5% essentially, and we would simply divide that by our $900 as our market price, and that would look very, very different. That wouldn't necessarily be a 5% coupon rate. That would look a lot different than we had before. And so the current yield is something that you definitely have to track. The coupon rate can be a little deceiving because if you're buying the bond at a premium, which means you're paying more than the par value, then obviously your current yield is going to be lower because you're paying more for that particular investment and not getting as much in return, of course. All right, let's go on to mutual funds and ETFs. Before I do this, though, related to bonds, of course, bonds are a significant source of financial resources for companies as well as government entities as well. In terms of risk, bonds are viewed to be as less risky generally than stocks of a company because if you're a bond holder, you have a guarantee on assets. So if a company goes bankrupt and has to liquidate, your interests are paid before stockholders are. Now, that typically means that the interest rate paid for bonds is usually a little less, but it depends on risk level. Remember, we talked about the difference between the risk and the return. Obviously, if I'm accruing more risk, I should be receiving more return. If I'm not accruing a great deal of risk, then I might not get a whole lot of return. Take, for example, the U.S. Treasury bonds. They're viewed as some of the safest securities you can possibly buy. And so you can invest your money in a U.S. Treasury bond for 30 years, and you can only get 1.5% because it's viewed very safe. Contrast that to maybe a Spanish bond where you do the same thing and you're getting 6.5%, maybe 7% on it because it's viewed as a riskier investment. So that's the only thing I'll say with regards to that. But let's go into mutual funds and ETFs here real quick. First thing I'm going to do is go over mutual funds. A mutual fund is a particular fund that pools assets together to invest. And so instead of you purchasing stocks in individual companies like Walmart or Hewlett-Packard or Apple or any other company, Starbucks, Target, whomever, what you can do is actually purchase a mutual fund. And so you're putting money into this fund. And a lot of people do this. And so what happens is the mutual fund accumulates a lot of financial resources, and then it takes those financial resources and then it purchases individual stocks. And so what you get with a mutual fund is you get instant diversification, which is a significant benefit. Instead of having to purchase each of the companies yourself and worry about, okay, my portfolio, I have 5% Walmart, I have 2.5% McDonald's, I have 7% is Apple, worrying about all that stuff, you can instantly purchase one particular security and already have exposure to all of those companies in a broad range of markets. You can purchase mutual funds for all different things. You can purchase mutual funds specifically for tech companies. You can purchase mutual funds for large cap companies, small cap, mid cap. There are a number of different mutual funds that you can purchase. But what they allow you is instant diversification as opposed to trying to acquire all of the different funds yourself. Another benefit of mutual funds is you have professional management. You typically have a fund manager who is in charge of actually deciding where to invest the particular resources of the mutual fund. And so they obviously have a financial background. Typically, these are individuals who have an MBA in finance, usually, and have been around for a number of years. And so they have a lot of experience with regards to financial markets. So the argument is they would be in a better position to determine what to invest in than maybe individual consumers like you and I. The next thing with mutual funds is there's a great deal of variety. You can, as I mentioned before, purchase mutual funds in all different sectors. You can purchase mutual funds for all different types of industries. You can purchase mutual funds that have a broad investment in a number of different industries to diversify. There are a number of different alternatives. You're not going to run out of a lack of variety with regards to mutual funds. The next thing you get with mutual funds is you get liquidity. Usually, mutual funds, you have a certain period of time that you have to invest them in. They're not like stocks where you're going to buy and sell them in the same day. Mutual funds you typically hold over a longer period of time, and usually you incur fees as a result of withdrawing your money from a particular fund less than usually 30 days. So although they're not as liquid as stocks and as other types of instruments, they still have a great deal of a fair amount of liquidity because you can at least gain access to them within a month's time. You could sell your mutual fund below the 30 days. You obviously will accrue some penalty fees as a result, but that doesn't mean that if you absolutely needed the money, you couldn't gain access to it. So let's look at one particular mutual fund here. This is a Fidelity Contra fund. So this isn't necessarily a fund that I recommend or anything. I just use it as an example, so don't read into this. But the Fidelity Contra fund is a particular mutual fund that does a number of different things. We'll get into that, but I'm more of using this as an example here. And so this is a kind of a screenshot from a particular, I think this is from E-Trade. So the second that you type in the ticker symbol, which for Fidelity Contra fund is FCNTX, you get a number of different pieces of information here. This typically is the dashboard that you see once you access the mutual fund. If you use a different service, whether it's Scottrade or anyone else, it might look a little different, but they typically encompass the same pieces of information. So the Fidelity Contra fund, you can see the first thing that we show here is a net asset value. That essentially is what you would pay for this particular fund. It's not the same thing as a stock price, but it's what you would actually give up in order to purchase one of these particular funds here. And you can purchase, obviously, more than one. But moving on here, you can see it tracks kind of the growth, of course. You can compare that to the S&P 500, which we'll get into, and as you can see, it's actually doing somewhat better than the S&P 500, doing much better than simply large cap companies are. The next thing you can see here that's important for mutual funds is you have all of the details related to expenses. You can see here what the expense ratio is, which is 0.81%. That is ultimately what you're going to pay as a result of holding this particular fund here. And so that's a way that mutual funds obviously get money, is they require that you pay fees. Now typically mutual fund fees are a little higher than things like ETFs, and that's because you're paying for a actual fund manager to manage this particular account. So you have their salary. If they're moving in and out of stocks fairly regularly, that accumulates fees because it takes money to sell a stock and then to purchase another one. And so those all have to be considered. So you certainly want to take a look at the fees of each particular mutual fund, because some are higher than others. Some go as high as, I've seen, 2-3%, and some are obviously in the area of 0.81%, which is considered to be fairly low. There also is an initial investment here. You can see towards the middle of the screen that it takes $2,500 to be able to invest in this mutual fund. And usually that's to ensure that it's kind of worth their while. They don't want to just purchase a small number of them, but they can purchase a larger number of stocks, of course. So if you were to invest, it would take $2,500 would be kind of your initial buy-in, of course. Although if you had an IRA, it would only be $500. One thing I want to point out too is if you look, mutual funds always detail what are their top holdings, meaning what are the primary companies that they invest in. So if you look on the lower right hand side of your screen, you can see that this particular mutual fund invests in Apple, Google, Berkshire Hathaway, Coca-Cola, as well as McDonald's. So out of the entire fund, 9.26% of the entire holdings are represented by Apple stock. And so you know that if you're looking for maybe some exposure to Apple, but you don't want to purchase their shares by themselves, you can purchase a mutual fund that maybe invests in Apple, has some of their holdings, so you have some exposure to them. And you can view the complete list of each company that is held in the mutual fund to get a better idea ultimately of what you're investing in as well. All right, so this lists the top 10 holdings. Before it was showing you the top 5. This shows you the top 10. Also gives you a snapshot of ultimately their return to date. So it tells you ultimately what their performance is. You can get a good idea for who's doing well and who's not doing so well. It shows you if they pay a dividend and what that yield is. So for example, Apple's dividend yield is 1.51%. Which means for every $100 that you invest, you get $1.51 in a dividend. If it's zero, that means the company does not pay dividends. And then also gives you access to other things like price-earnings ratios and other factors as well. You can also see performance. That's an important thing to look at for dividends. Not only the expense ratio that you pay, but ultimately, what type of performance does it yield? Is it good? Is it bad? And also comparing that to other mutual funds that maybe perform the same function. This particular mutual fund is invested for large cap stocks. Large cap stocks are companies that are valued over, I believe it's $50 billion. And so to determine the valuation, you take the number of shares outstanding and you multiply that by the market price per share. And that gives you ultimately what its capitalization is, essentially. And so large cap stocks obviously are the most successful stocks. They're worth the most amount of money. And so usually they're viewed as safer investments, of course, rather than maybe a small cap stock that might be worth somewhere in the realm of maybe just $1 million or so. That would maybe not be as good of as an investment, or at least it might be a little riskier as an investment. So typically large cap stocks are viewed as stocks that are more safe generally, although you still see some fluctuation there. All right, next thing here is this just kind of shows the different fees and what the breakdown is for those. As I mentioned before, you do want to take a look at those particular fees in comparison to other mutual funds. Obviously, it shows the average here. If you look to the bottom left-hand corner of your screen, is 1.27% would be the average for the funds, which there are 431 funds that are invested in the large growth category. And so 0.81% is obviously less than the average, so this is a pretty good deal. The fees are obviously pretty decent, but you would still want to look at what the performance is like, because just because you're paying low fees doesn't mean it's a good investment. You have to see what's the track record, what's the long-term growth over the last 3, 5, 10 years. Has it performed historically well? All right, the next thing we're going to get into are ETFs. ETFs are very, very similar to mutual funds, but there are a few differences that are very, very important to note. The first thing is that an ETF does not have a fund manager. It works the same way. It invests in a collection of different stocks. However, it doesn't have the fund manager necessarily buying and selling those particular shares and determining what to invest in and what might be appropriate. Usually, it's a kind of a computer algorithm almost that is designed to track the overall flow of certain markets. So for example, we're going to get into market indexes like the S&P 500. There are mutual funds that are designed simply to track the S&P 500. So when the S&P 500 moves up 2%, that mutual fund, because it tracks it, should go up 2%. And so you're simply just trying to copy or mirror the behaviors of certain markets. And you can track a number of different things. You can track certain dividend-paying stocks. You can track technology stocks. You can track small-cap stocks, large-cap stocks. There are a number of different indexes that can be used for ETFs. But where they differ from mutual funds is that you can buy and sell them in the same day. With mutual funds, if you purchase a mutual fund, it isn't officially done until the next day, because the mutual fund has to collect all of the buy and sell orders over that day, assess a new net asset value or purchase price, and then establish that for the next day. With a ETF, much like a stock, you can go online, execute an order, and you can own that ETF almost instantaneously as well. So you can move in and out of certain markets much quicker with ETFs versus a mutual fund could. The next thing with ETFs is you typically enjoy lower fees because you don't have a fund manager who's actually being paid to manage the actual assets that the mutual fund is holding, and because it's more of a computer algorithm designed to track an actual fund, or track an index, I should say, and that usually yields to lower expense ratios. You can find some as low as 0.05%. I've seen some as 0.13%, so very, very low in comparison to mutual funds, which certainly provides a great number of benefits because you can get some exposure to a wide market or a wide group of stocks, but also you're not paying very, very much in comparison to mutual funds. And remember, the lower your expense ratios are, the more money you get to keep. So if you're paying 2 to 3% in expenses just for that mutual fund, that is reducing your overall return at the end of the day. So let's look at some important aspects of mutual funds. I have here the Vanguard S&P 500 ETF. What this ETF does is it tracks the S&P 500, and so it's designed to mirror the movements of the S&P 500. Typically over a long period of time, usually the S&P 500 grows at an 8% annual rate over a long period of time, of course. We've seen over a short term, it does different things. And so if you wanted to invest in an ETF that mirrored the S&P 500 for a long period of time, you hopefully would take advantage of about an 8% interest or 8% return on an annual basis. So what are some of the key things here? Well, first you notice that it has the price. It shows you the change in today's price. So in this case, you can purchase this ETF for $67.11. It's down 4 cents or 0.06%, of course. You get information like the volume, which is the number of shares that are being traded that particular day. So in this case, there are 2.5 million shares roughly changed hands over this particular day. But you also get more important information here. If you look toward the middle of your screen, you see here that this actual ETF pays a dividend. So every quarter, you get 32 cents for every share that you own, in addition to that share price appreciation. We're finding in these markets where there's a lot of volatility, dividends are becoming very, very popular because at least it's a guaranteed form of payment. And so we've seen a lot of popularity, a lot of growth in the ETF, in the dividend market specifically, because investors are wanting at least a for sure investment. At least if I can get 1.84%, which is the yield for this ETF as a dividend, that's at least guarantees me I get a little bit higher than the maybe 0.25% that I'm going to earn in my savings account. All right, next thing that you look at here, it shows expense ratios. It shows the overall strategy of this particular fund, which you can see here. It's an indexing investment designed to track the performance of the S&P 500, and so that's what it's going to do. It gives you some average annual returns, shows ultimately for a year, what's the return for 3 years, for 5 years since inception. This is a very new investment. ETFs are fairly new, much more new than mutual funds. As you can see, this ETF started on September 7th of 2010, so very new. But look at the expense ratio in the bottom left-hand side of your screen. It's 0.05%. That's extremely low. And so what that does is it allows you to keep more of your returns because they're not going towards paying for things like expenses. All right, hopefully that provides you a little bit of an overview of some of the different investment options that you have. You are obviously going to want to acquire additional knowledge if you want to invest in these types of things, but at least you should know ultimately what they are, advantages, disadvantages, and those types of things. So let's get into primary and secondary market offerings. First, we're going to talk about an IPO, which is an initial public offering. An initial public offering is when a company decides for the very first time it's going to sell shares of its own company on an open market, typically through an exchange like the New York Stock Exchange or the Nasdaq, which is the National Association of Securities Dealers Automated Quotient. And so, for example, companies like Facebook, Pandora, and LinkedIn just went through initial public offerings. Facebook was the most recent out of these three, where when it sold its stock on the open market for $38 per share, and then investors could essentially purchase Facebook stock for that amount of money. And so Facebook essentially is receiving the proceeds from those, and in return, investors are getting shares of ownership in Facebook, and then hopefully some type of appreciation in stock over a long period of time. Now, obviously, Facebook's IPO did not go the way most people wanted to. It ended up declining significantly, ending at one point to around $17, $18 per share. It just got up to about 21, so it's slowly kind of beginning to get a little bit of traction. But if you were to purchase Facebook shares at $43, which at one point, briefly, they were at $43 per share, and now your investment's down at the $21 range, obviously that's a little bit concerning. But during the initial public offering is when the company is going to gain access to funding. So at that period of time, it's going to take the investment from the market, distribute shares, of course, with the help of an investment banker like a Goldman Sachs or a JP Morgan Chase, and then it has that money available to put forth for operations and to support growth in that company. Now, outside of the initial public offering, you can purchase shares on secondary markets. And this is generally where investors like you and I are going to purchase shares. We generally don't participate in initial public offerings because that's really reserved for institutional investors and different types of more affluent investors, let's just say. We usually purchase shares on secondary markets. And so there are a few different secondary markets. You have the New York Stock Exchange and you have the Nasdaq, which I obviously referenced what that acronym stands for. In secondary markets, if you purchase a particular share, you're not purchasing the share from the company. What you're doing is you're actually buying that share from someone else who already owned it and is deciding to sell it. So in secondary markets, companies don't raise any financing. They've already done that through the initial public offering. But in secondary markets, those who hold shares already, those investors who have them, it can pair the people who want to sell their shares with the individuals who ultimately want to buy those particular shares. And so the first one is the NYSE, referred to as the New York Stock Exchange, by far the most popular stock exchange. When people refer to the stock market, that is generally what they are referring to. It was founded in 1719, and so it's been around for a long period of time. It incorporates a trading floor, which is what you commonly see when you get to the closing bell, which is at 1 o'clock Eastern Time. When the trading floor is done, you typically see traders frantically waving pieces of paper in their hand and yelling at people to execute trades. That's the trading floor. It also incorporates a hybrid market, which is done completely over the internet. And so what this allows us to do is we can place trades at our computers. Those get transmitted to the trading floor. And then what the traders do is they're responsible for executing those particular orders. Once they're executed, they signal that the transaction was approved. That gets logged in the computer, and then ultimately you see on your end ultimately how many shares you purchased and at what price you were able to acquire those shares. So simply because you execute an order at a certain price doesn't mean you're going to get the share or get the stock at that particular price. Now the Nasdaq works in a very similar fashion, although it's entirely electronic. It's the world's oldest electronic market exchange, and so all buy and sell orders are executed electronically under the actual Nasdaq here. So there isn't a physical trading floor as there is with the New York Stock Exchange. All buy and sell orders are handled electronically, and what Nasdaq does is it matches people that want to sell a share at a certain price with people that are willing to buy them at a somewhat similar price. All right, so how do we gauge the performance of the market? There are what we call market indexes or stock indexes, and what these things allow us to do is get an overall gauge over the performance of a large number of companies, the overall market, if you will. And so with stock exchanges, we're going to track the prices of certain stocks, and there are a number of different exchanges. I'm going to view simply the three most common or popular ones, but there are a number of different exchanges out there. First one I'm going to review is the Dow Jones Industrial Averages. This is probably one of the most widely regarded and followed exchanges out of all of them that are in existence. And what this does is this tracks the performance of 30 blue chip large cap stocks that are on the New York Stock Exchange. And so when we mention the words blue chip, we're referring to the most stable of stable companies. These are the largest companies that have been around, that are very, very popular, have done very, very well. Companies like Disney, companies like Coca-Cola, and countless others. And these companies are obviously very successful, have long track records of performance. And although this is the oldest and most widely followed index, it's not necessarily characteristic of most companies, right? Most companies aren't your blue chip large cap stocks worth billions and billions of dollars. And so this might not be an accurate representation over what the overall movements of the market are, but it is certainly used as a barometer for health in the overall equities market. You typically see this is one of the most widely cited market or indexes or stock indexes for an extended period of time. People always want to know, well, the Dow Jones was up such and such percent or such and such number of points, whatever the case may be. And so although it's widely used, it may not necessarily be the best way to track the overall movements of the market, because we're looking at simply the best of the best in terms of companies. We're not looking at the smaller, more common companies that may be more characteristic of the overall market, essentially. All right, the next common index is what's called the S&P 500 or Standard & Poor's 500. The S&P 500 tracks the performance of 500 large cap stocks from a variety of different sectors. And so the idea here is we're trying to get at least an accurate representation of ultimately what the large cap equities market is doing from a variety of different sectors. And so the goal here is to try and get a balanced representation. We want to see ultimately for the overall large cap equities market, which still are obviously companies worth a great deal of money, what is the performance like? And so obviously if you track more companies, you're probably going to get a more reliable result rather than just going off of maybe 30. So this is viewed as probably the single best indicator of the U.S. equities market, although it isn't necessarily as widely followed as the Dow Jones Industrial Averages. The last stock index I'll go over is the Nasdaq, which is the National Association of Securities Dealers Automated Quotient. And the Nasdaq includes approximately 3,800 companies spanning 6 different continents. The Nasdaq has a heavy presence of technology companies, and so it is widely used to follow the overall movements of the technology sector. But the issue here obviously is you're not being representative of the entire market. You're looking solely at the technology sector. And so if your interest is obviously seeing the movement of technology stocks like Apple, Google, Microsoft, then this might be a good thing to follow, or at least Apple and Google, this might be a good thing to follow. But you're not going to get a good exposure to some of the other different sectors like obviously healthcare and maybe retail and those different types of things. But still a very, very good ultimately market or index to follow. All right, that concludes our discussion for obviously financial markets, providing a brief introduction. Hopefully that provides at least some clarification on some of the different issues that are seen. If there are any issues, obviously please do let me know, but that should at least give you somewhat of an overview of some of the important aspects of financial markets, of course, and ultimately how to look at stocks, what are the different instruments available, and how do we gauge performance of the overall market. Thank you so much for joining. Have a great week, and we'll see you next time.